Welcome to Talk Tickers, your deep dive into the most critical earnings calls defining the market.
Today we're digging into Toll Brothers, ticker TOL, and their Q4 fiscal year 2025 earnings call.
And this one was interesting. The call was pre-market Tuesday, but the numbers dropped after hours before that.
And the reaction was immediate. And, well, not in a good way.
Not at all. The stock just dropped. It closed the day of the call down significantly, which is strange when you hear management talk about what a great year they had.
Exactly. So that's the tension we need to unpack here. You have this story of operational strength, but the market just completely ignored it and focused entirely on the future.
Right. So let's start with that headline conflict. The actual results snapshot.
It was really a tale of two lines on the income statement. You had the top line and the bottom line telling very different stories.
Okay, so revenue was $3.42 billion. That's a pretty solid beat against what the street was expecting.
A solid beat, yeah. About 3% better than consensus. And importantly, it was up, 4 to 5% year over year?
In this housing market, that's real growth.
It is. But the problem, and this is the big but, was on the bottom line. Earnings per share.
Diluted EPS came in at $4.58. And that was a miss.
A definite miss, yeah. The consensus was up around $4.88, so short by about 30 cents. A 6% miss. And it was also down a little from the year before.
Now, usually a revenue beat and EPS miss screams margin problem, but management was out there immediately with a defense.
They were. They said this wasn't about the core business at all. They argued the miss was basically a technical issue. A timing thing.
Right. This had to do with that huge sale of their apartment portfolio.
Exactly. The sale of about half of their Toll apartment living business to Kennedy Wilson. It's a massive $380 million transaction.
And it was supposed to close in Q4.
It was, but it got pushed just barely into Q1 of the next fiscal year. So management's argument is, look, if that deal had closed on time, our core home building operations were so strong we would have easily beaten the EPS number.
But the market sell-off suggests they didn't really buy that, did they? If it was just a simple timing delay, you'd think they would have looked past it.
Well, I think they heard the excuse, but they also saw the other numbers, particularly the guidance that we're about to get into. The market is always forward-looking.
Okay, so before we get to the guidance that spooked everyone, let's stick with FY25. Management really tried to frame this as, another strong year.
And it was. I mean, by many metrics, it was a record year. They hit $10.84 billion in home sales revenue, delivered over 11,000 homes.
For me, the number that really stands out is the return on beginning equity.
Oh, absolutely. 17.6% ROE. For a home builder, which is a super capital-intensive business, hitting almost 18% in this environment is a sign of really, really disciplined management.
And what about margins? Because that's always the fear.
Margins held up surprisingly well. The Q4 adjusted gross margin was 27.1%. That was actually a little better than they had guided for.
Though it was down a bit year over year.
Down about 80 basis points, so less than 1%. It was a controlled compression, not a collapse. And on the cost side, SG&A was flat at 8.3% of revenue, which shows they're keeping a lid on overhead.
And they're just swimming in cash.
They are. Generated $1.1 billion in operating cash flow and gave a huge chunk of it back to shareholders. $750 million through buybacks and dividends.
And their balance sheet looks great. Net debt to capital is super low at 15.3%. They have plenty of dry powder.
Right. So this paints a picture of a really healthy company.
Yeah.
And that brings us to their core advantage, which they just kept hammering on during the call.
Their customer, the affluent buyer.
And they brought the receipts to prove it. Over 70% of their business is move up and move down buyers. These aren't people stretching for their first home.
The financial proof is pretty wild.
It really is. In Q4, 26% of their buyers paid all cash. A quarter of their buyers.
All cash. And the ones who did get a mortgage weren't exactly sweating it.
Not at all. The average loan to value was around 69%.
So people are putting down 30% or more. That tells you they have massive equity from a previous home or just a lot of wealth. They're insulated from these high rates.
Totally. And you see that commitment in the cancellation rate. It was only a 4.3% of their starting backlog. These customers are locked in.
Which brings up a fascinating point about incentives. They offer things like mortgage rate buydowns, but almost no one takes them.
Because they don't need to. Their buyers are using those incentive dollars for other things. Upgrades. They're funneling the cash into the design studio, into structural options. They're customizing their luxury home.
And that's highly profitable for Toll, right?
Extremely profitable. The average buyer spent another $26,000 on top of the base price. That's 24% of the price of the home. And those dollars are very high margin. It's a brilliant model.
They also talked about getting faster by blending build to order with more spec homes.
Yeah, specs were 54% of their deliveries. And they've tweaked the model so that now 35% of their communities can deliver a home in under 8 months. That speed helps them capture buyers who want to move quickly.
Okay, so we've established FY25 was, by all accounts, a fantastic record-setting year. Which brings us back to the big question. Why did the stock get absolutely crushed?
Deep dive 2, the FY26 guidance. This is where the story completely flips.
The forward look was just bleak.
It was, and it starts with the backlog, the pipeline of future business.
Net signed contracts in Q4 were down almost 5% in units.
And that flows directly to the year-end backlog. It was down 22% in units and 15% in dollar value year over year. A 22% drop in your starting pipeline is a major red flag.
And that forced them to guide down their delivery volume for next year.
Right. For FY26, they're guiding to about 10,500 homes at the midpoint. It's a noticeable drop from the 11,292 they just delivered.
And they gave a very specific breakdown of how they got to that 10,500 number, and it really shows you how conservative they're being.
It does. So they started with 4,500 homes already in their backlog, easy enough. Then you have 3,000 spec homes that are already being built.
So that's 7,500 homes that are more or less a sure thing.
More or less. The rest has to come from new sales. They're penciling in 1,500 build-to-order homes that will sell and close within the year, and then another 1,500 new spec homes they'll start for summer deliveries.
And those last two buckets are the risky part. What kind of sales pace are they assuming?
A very slow one. Just 2 contracts per community per month. They are basically assuming the market does not improve at all from its current choppy state.
And it wasn't just volume. They guided down on margins, too.
A big drop. They're projecting adjusted gross margin to fall to 26.0%. That's down from 27.3% this year. That's a 130 basis point hit.
And what's driving that?
Incentives. They're budgeting about $80,000 in incentives per house. That's up from $68,000 this past year.
So they're spending an extra $12,000 per home to keep the sales pace from falling even further. They're buying volume.
They're sacrificing margin for velocity, especially on those spec homes they need to sell in the back half of the year.
On top of that, their SG&A costs are going up as a percentage of revenue.
Right, to 10.25%. About half of that increase is just because the revenue base is smaller, so costs look higher. The other half is inflation and, interestingly, higher sales commissions for realtors.
So you put it all together. Lower deliveries, a smaller backlog, compressed margins.
And you get a very, very conservative tone. The CEO and CFO both said it explicitly. We're not assuming any market improvement.
And when you run the math on their guidance, the implied EPS for next year comes out around $12.36.
Which was way below the Wall Street consensus of $13.83. That's an 11% gap.
Yeah.
And that is why the stock sold off so hard. They reset expectations downward in a big way.
So they're playing defense. They're saying the real test is going to be the spring selling season, which starts in late January.
Exactly. If things get better, they're set up to look like heroes. If they don't, well, they've already warned you.
Let's shift gears to their bigger strategy, because there's a major change happening here. They're trying to become a pure play builder.
This is a huge deal. They are getting out of the multifamily apartment business. That sale to Kennedy Wilson for $380 million is just the first step.
Why do that now?
Because management feels the market isn't giving them any value for it.
Yeah.
By selling it off, they unlock all that capital, clean up the story, and can refocus on what they do best. Building luxury single-family homes and maximizing that ROE.
And they're still growing the core business. Community count is going up 8 to 10% next year.
Absolutely. And they're doing it in a very disciplined way. They continue to target a 60-40 mix of option land versus owned land.
Which is key, right? It means they control the lots for future growth without having to tie up billions of dollars in capital owning the dirt.
It speaks directly to that focus on capital efficiency and ROE. It's a smart, low-risk way to grow.
So how does Toll stack up against the rest of the industry right now?
They've actually been a relative outperformer. The stock is up about 8 to 10% year-to-date in 2025, which is better than the overall homebuilder ETF. So that luxury focus is paying off.
And the market reaction to the call was huge. Trading volume was almost double the average. Options activity was more than triple.
Everyone was processing this guidance. The market is clearly taking a risk-off stance, focusing on the negatives for next year and ignoring the great results from this year. The big catalysts now are that Kennedy Wilson deal finally closing and, of course, what happens this spring.
Okay, that's the perfect setup for our final segment. Let's talk about how to play this. But first, we have to say it. We are Talk Tickers. This is for informational and entertainment purposes only. It is absolutely not financial advice. always, always consult with a licensed professional.
Absolutely. Okay, with that disclaimer out of the way, let's talk about the outrageous but plausible trade.
The setup is just perfect. Management has been so explicit about how conservative they're being. They've practically laid out the script for an under-promise, over-deliver scenario.
Right. The whole trade idea is simply a bet that the CEO is sandbagging, that this assumption of no market improvement is just setting a very, very low bar.
So the idea is something like a long-dated, deep-in-the-money call option, maybe tied to their Q2 results, which will give us the first real numbers from that spring selling season.
The thesis is simple. What if a few things go right? What if Treasury yields stay low? Maybe the Fed even hints at a cut, and all those affluent buyers who have been sitting on the sidelines finally decide the rate lock-in effect is over.
And that demand could come back fast.
Very fast. And because of their spec strategy, Toll can meet that demand. Those 1,500 new specs can turn into deliveries and revenue much quicker than the market thinks.
And that 26% margin guide suddenly looks way too low. If the spring season is strong, they could be forced to raise guidance in a huge way.
That's the plausible outcome. The stock blows past its old high of $136. The outrageous part is you're betting that the CEO's public caution is just a tactic.
A bet on their history, really.
So to wrap this all up, FY25 was a record year, driven by a wealthy, resilient customer who cares more about kitchen upgrades than mortgage rates.
But all of that was completely ignored because of an incredibly conservative FY26 guidance that assumes the housing market doesn't improve at all.
And all while the company is sharpening its focus to become a pure-play, capital-efficient luxury builder.
So given that Toll has beaten their delivery guidance in 11 of the last 12 quarters and their margin guidance for 12 straight quarters, the real question for you to think about is this. Is the CEO's conservatism genuine caution? Or is he just setting the stage for a massive beat as soon as the spring selling season gives him the cover to do it?
Something to think about while we wait for those first spring numbers to roll in.
Thanks for diving deep with us. We'll catch you on the next call.